Hey, this is Mike Durr, the Kingwood Mortgage Guy. And listen, I had a recent situation come about with a borrower that had co-signed for one of their family members. And I thought it was a good time or a good opportunity to kind of share with you what I learned when somebody has co-signed. And one of the things that you have to be aware of is that when you are co-signing for somebody else, it is represented, or it's called, a contingent liability. Now, what a contingent liability means is that there's a potential that you may be required to make the payments on that debt. And so it concerns underwriters when there are contingent liabilities on there. Matter of fact, in the underwriting and in the guidebook for FHA loans, it says very specifically that if there are contingent liabilities on your credit, that you're required to count those in the debt ratio unless one or two things happens. The first thing is you have absolute bona fide proof that the creditor will not hold you responsible if that debt's not paid. And unfortunately, that's just not likely to happen. I mean, there's not many people that are going to say, well, you signed on it, you don't have to pay. But the second rule is that if the payment has been made consistently for 12 months in an on-time method, or you paid it 12, or you haven't paid it, but the person you co-signed for has paid it for the last 12 months without fail, then it doesn't have to be counted in your debt ratio. Okay, so that's good news. It doesn't mean that necessarily just because you did it, you're going to eliminate it from buying a house. But here's the rule. You have to be a little bit careful as to when you co-sign. So if you co-sign like 2 or 3 months ago, well, you're not going to have 12 months of proof that they have paid that obligation on time because it hadn't been 12 months. So you just imagine that if you co-sign for somebody, you have to be aware that you're kind of stuck for the next 9 or 10 months before you'll be able to qualify. And I want to stop there and say, just because you co-sign for somebody, you may be comfortably able to handle that debt and any of the other debts. But in most cases, like the situation I'm going through right now, the debt was on a car, and the car was almost $750. Well, $750 will eat up a lot of debt ratio for you. So you got to be careful about when you do it. The second thing is that even though it might have been a year or two ago, and then you are, well, I don't know, you may or may not be aware that they're making their payments on time, but if they ever do miss one payment, then the 12 months starts over again. So the message is that you just have to really be careful when somebody asks you to co-sign. And co-signing is a blessing to the person you're co-signing for, but it may be a real mess for the person that does the co-signing. And my recommendation is you might want to pass. But anyway, there is an opportunity to do a loan even if you've co-signed. This is Mike Durr, the Kingwood Mortgage Guy. I'd like you to call me. This may not have answered your specific question, so just call me and I'd love to chat with you about your question. Talk to you later. Bye-bye.